There is an industry in America that holds $9.6 trillion, not earns, holds. It sits on more money than the entire American banking system keeps in cash, and almost none of it belongs to the companies holding it. It belongs to their customers. Last year, that industry made $153 billion in operating income, up 43% in 12 months. Its best year in a decade. So insurance companies must be very good at what everyone assumes they do. Take in more in premiums than they pay out in claims. Not exactly. In 2024, the largest home insurer in America looked at its Illinois customers and reported that for every dollar it collected in premium, it paid out $1.26. That is State Farm. That is not a small state, and that is not a bad year by their standards. The year before, it was $1.30. And a quick note before we go further, everything in this video is property and casualty insurance. Car, home, business, the insurance you actually buy. Losing 26 cents on every dollar and still a valuable business. Which means the thing everyone thinks insurance companies do for a living is not in fact how they make their money. So how do insurance companies actually make money? Money enters an insurance company the same way it has for 300 years. A customer pays a premium. They pay it now, every month, whether anything happens or not. And the company pays the claim later, sometimes much later. That gap between the money arriving and the money leaving is the entire business. Everything else is detail. Insurers have a single number for how well the first part is going. It is called the combined ratio, and it is simpler than it sounds. It is how many cents go out for every dollar that comes in. Under 100, the company kept something. Over 100, it paid out more than it took. Last year, the American property and casualty industry ran 92.2, 92 cents out, 8 cents kept. On a business that collects hundreds of billions of dollars, 8 cents on the dollar is real money. It is also the smaller half of the story. And that 92 was a good year, an unusually good one. Across the whole industry, underwriting profit came to $60.9 billion, nearly triple the year before. The reason was not clever pricing or better technology, it was weather. Fewer storms made landfall, fewer roofs came off, and the claims that did not arrive dropped straight through to profit. Which is the first uncomfortable thing about this business. Its best year in a decade happened mostly because the sky was calmer than usual. So where does the 92 cents go? The largest piece by far is claims, the money actually paid to people whose cars were hit and whose roofs came off. Hail alone cost State Farm $638 million in Illinois in a single year. One weather event, one state, one company. Then the cost of settling those claims. Adjusters, engineers, lawyers, the people who drive out to look at the roof. Assessing a claim is itself an industry. Then acquisition. What it costs to win a customer in the first place. Commissions to agents, and advertising, which in this industry is enormous and which we will come back to, because one company decided to stop. Then the part almost nobody outside the industry knows about. Insurance companies buy insurance. It is called reinsurance. The insurer takes the premium, keeps some of the risk, and pays someone bigger to take the tail. The rare, enormous company-ending event. The reinsurer meets no customers, sells no policies, and handles no claims. It exists to absorb the worst day. Globally, the capital standing behind that promise reached a record $785 billion. Keep the reinsurer in mind. When we get to who actually wins, they will be standing at the front of the queue. Here is the part that changes what an insurance company even is. Go back to the gap. A premium is paid today. The claim, if it ever comes, is paid months or years from now. In between, the company is holding somebody else's money. Not one person's, everyone's. Millions of premiums arriving every month against claims that have not happened yet. That pile of other people's money has a name in the industry. It is called the float. And it is enormous because it never fully drains. Old claims are settled and closed. New premiums arrive the same morning. The individual dollars turn over constantly, but the pile itself only grows. And the float is not sitting in a vault. It is invested. Bonds, mostly. Boring. Government and corporate debt that pays a small percentage every year, which is why insurance companies are among the largest bondholders on Earth. When a government or a corporation borrows money, a very large share of the lending is being done with premiums that have not turned into claims yet. Last year, American property and casualty insurers earned a book yield of 4.39% on those investments, the highest in a decade. Bonds and mortgage loans alone account for 77% of the industry's investment income. Now hold both halves together. The company keeps 8 cents on the dollar from underwriting, and separately it earns 4% a year on a mountain of money it does not own. Berkshire Hathaway, which is really an insurance company with other businesses attached, held $176 billion of float at the end of last year. In 2015, it was $88 billion. It has doubled in a decade. Think about what that is. $176 billion available to invest, that belongs to policyholders. In any other industry, there is a word for that: borrowing. And borrowing costs money. A bank pays interest to hold a deposit. A company issuing a bond pays a coupon. Borrowed money has a price, always. Except here. Berkshire's cost of float has been negative in each of the last 3 years. Negative. Read that again. Because their underwriting ran at a profit, they were not paying to borrow that $176 billion. They were being paid to hold it. That is the mechanism. An insurance company is not primarily a seller of protection. It is a borrower that has arranged to be paid for borrowing and then invests what it has borrowed, which reframes the whole industry. The question is no longer how much profit an insurer makes on a policy. The question is how cheaply it can hold the money. And that explains something that looks irrational from the outside. Insurers competing hard enough to price a policy at almost no margin. From the outside, it looks like a company forgetting to charge enough. From the inside, it is a company buying float at close to zero, which is the cheapest money in commerce. And now State Farm's $1.26 makes sense. Losing money on underwriting is survivable, sometimes indefinitely, as long as the float is large enough and cheap enough. Underwriting is the cost of acquiring the float. The claim is real, the protection is real, but the business is the loan. Which brings us to the strangest turnaround in modern American insurance, and it proves the mechanism by inverting everything a company is supposed to do. Geico, the gecko. One of the most advertised brands in the country, built over decades on a single promise about saving 15% and on spending extraordinary amounts of money to tell you so. In 2022, Geico lost $1.9 billion on underwriting. Its combined ratio was 104.8. For every dollar it collected, it paid out nearly 105 cents. By the standard logic of growth, the fix is obvious. Sell more policies. Spread the fixed costs. Advertise harder. Geico did the opposite. It cut its headcount by more than 30%, down to about 28,000 people. It cut annual operating expenses by 24% to $4.1 billion. It raised prices, and it let customers leave. Policies in force actually fell. A company whose entire public identity was built on winning customers deliberately had fewer of them. In 2023, underwriting profit was $3.6 billion, combined ratio 90.7, down more than 14 points in a single year. In 2024, it was $7.8 billion, more than double again, from losing $1.9 billion to making $7.8 in 2 years while shrinking. Because the goal was never the number of policies, the goal was cheap float. A smaller book of better-priced policies produces a cheaper float than a larger book of badly priced ones. And notice which lever moved first. Not claims, which are largely outside a company's control once the policy is written, expenses and price, which are entirely inside it. $4.1 billion of operating cost, cut by nearly a quarter. The advertising is the part worth sitting with. A brand that spent decades and billions of dollars teaching an entire country a single sentence about 15 minutes and 15%, deciding that some of those customers were not worth the price of winning them. In most businesses, shedding customers is a crisis. In this one, it can be the strategy. So who actually makes money in insurance? Start with the reinsurers, the companies standing behind the companies. Last year, they earned $25.2 billion between them, up 23%. And look at how they did it. The average reinsurer ran a combined ratio of 83.9. Munich Re ran 73.5. Swiss Re 79.4, with a return on equity of nearly 20%. Set that against the primary industry's 92.2. The company that sold the policy keeps about 8 cents on the dollar. The company standing behind it keeps about 16. Twice the margin, on a business with no call center, no adjusters, no advertising, and no customers who have ever heard of them. The reason is that reassurers sell to insurers, not to households. There is no brand to maintain and no retail price to defend, and they take the risk that is easiest to price because it is the rarest. A 1 in 200-year storm is a mathematics problem. A fender bender in traffic is millions of small human ones. Then the brokers. They earn a commission on placing the policy and carry none of the risk. If the claim comes, it is not their money. We saw exactly this shape in the trucking video. A freight broker sits between the company with the cargo and the truck that moves it, takes 12 to 20% for knowing where the freight is, and never buys a tank of fuel. Different cargo, identical position. The middle of a transaction is a very good place to stand. And then the insurers themselves, but only the ones with cheap float. Not the biggest, the cheapest. Geico proved you can get there by getting smaller. Now the uncomfortable part. Premiums went up. Auto insurance rose about 19% in a single year, and home insurance in some states rose faster than that. It is easing now, roughly 15%, then 10, then about 7 this year. But those increases landed, and then the industry posted its best result in a decade. Both of those things are true at once, and the honest version is that they are connected, but not in the way it looks. Rates rose because claims genuinely got more expensive. Repairs, replacement, weather, the record result came after, and it came partly from a quiet year of storms. The policyholder is not being robbed, but the policyholder is also not the one the machine is built for. So here is the thing to carry out of this. Every month, money leaves your account and goes to a company that will hold it on average for years. It invests that money, it keeps what the investments earn, and if it prices its policies well, it is paid for the privilege of holding your money at all. You are not really buying protection. You are making a loan on terms you did not negotiate to a borrower who is being paid to accept it. The protection is real, and on the day you need it, it is the only thing that matters. But it is the product, not the business. The next time that payment leaves your account, it is worth knowing where it actually goes. Not into a vault, waiting for your accident, into a bond, earning 4% for somebody else. So here is the question. Now that you know your premium is really a loan, does that change how you feel about paying it, or does it not bother you at all? Bothered or not bothered? One word in the comments. I will go first, and I am somewhere in the middle. Thanks for watching. Subscribe, and we will take another business apart.